Hello, and welcome back to Flexible Budgets and Standard Cost Systems. This video will cover part two of Flexible Budgets and Standard Cost Systems. As a disclaimer, I do not own the rights to this content. All rights belong to the original authors, Miller Nobles and Madison, and of course, Pearson Education. This material is used for educational purposes only. So in this video, we will cover Learning Objective 2, identify the benefits of a standard cost system, and understand how standards are set. So why do managers use a standard cost system to control business activities? Why do managers use a standard cost system to control business activities? Well, most companies rely on standards to create budgets. A standard represents the expected price, cost, or quantity under normal conditions. For instance, based on Exhibit 5, the company Cheerful Colors anticipates that direct materials will cost $1.75 per batch of 100 crayons. Now, this means the standard cost for direct materials is $1.75, which is used in both the static and flexible budgets. Now, while the terms standard and budget are sometimes used interchangeably, there is a key difference. And one is a budgeted amount refers to the total expected cost. A standard amount is a per unit cost. For example, the standard cost for direct materials is $1.75 per batch, and the budgeted amount for 52,000 batches is $91,000. That's $1.75 times the 52,000 batches. Now, this company, Cheerful Colors, follows a standard cost system, meaning it applies standard costs to its product costs, including the direct materials, direct labor, manufacturing overhead. Now, each input has both. It has a cost standard, which is the expected price paid per unit of input. And then we have an efficiency standard, which is the expected amount of input required to produce each unit. For example, the amount of wax that's used per crayons. Here in Exhibit 6, it outlines a process of setting standard costs, a crucial yet challenging aspect of a standard cost system. Establishing accurate standards requires coordination and communication across multiple departments. For the direct material standard, the cost standard for direct materials begins with the base purchase cost of raw materials. Accountants collaborate with managers to determine this cost by factoring in 1, the purchase discount, 2, freight and costs, receiving and handling expenses. Building strong relationship with reliable vendors help ensure quality materials, on-time delivery, and cost efficiency. Now, with the direct labor standard, for direct labor, accountants and HR managers, they work together to establish labor cost standards. So this involves basic pay rates, payroll taxes, fringe benefits, okay? The job descriptions define the experience level required for each task, making it essential to provide proper training and ensure fair compensation. And then we have the manufacturing overhead standards, okay? The manufacturing overhead standards. Accountants collaborate with production managers to estimate manufacturing overhead costs. Now, this involves selecting an appropriate allocation base, such as your direct labor hours, direct labor costs, activity-based costing, or ABC. So after determining the allocation base, accountants calculate the standard overhead allocation rates to ensure accurate cost tracking and budgeting. In Exhibit 7, as you see here, the standard cost calculations, you have the direct materials cost standard for the wax. You have the purchase price net of discount at 31 cents per pound, delivery, receiving, and inspection at 4 cents per pound. So the total standard cost per pound of the wax is 35 cents per pound. Then you have direct labor cost standard, the hourly wage at $10 per direct labor hour, and then the payroll taxes and fringe benefits at $2 per direct labor hour. So the total standard cost per direct labor hour is $12. Then you have the variable overhead cost standard. Estimated variable overhead cost is $37,500. Then you have the estimated quantity of allocation base at 12,500 direct labor hours. So when you divide that, you get $3 per direct labor hour. And then you have the fixed overhead cost standard. The estimated fixed overhead cost at $25,000. The estimated quantity of allocation base is 12,500 direct labor hours. When you divide that, you get $2 per direct labor. So these cost standards provide a foundation for budgeting, performance evaluation, and cost control within this company, which is Cheerful Colors, their operation. Cheerful Colors has carefully analyzed its manufacturing process to establish efficiency standards for direct materials and labor. Now, these standards, also known as quantity standards or usage standards, it measures the optimal amount of input needed for production. So for the direct material efficiency standard, the production managers and engineers, they determine the precise amount of wax required per batch to minimize waste and also to maximize efficiency. If employees handle materials properly without spillage or excess use, the direct materials efficiency standard ensures that the right quantity is used per batch of crayons. And with the direct labor efficiency standard, to enhance labor efficiency, companies, they analyze each step of production to eliminate wasteful practices. So the common improvements include rearranging machines to improve workflow and reduce material handling, conducting time and motion studies to streamline tasks, installing conveyors at waist height to minimize unnecessary bending and lifting. Companies, they often benchmark their efficiency standards against best practices. Now, this may involve internal benchmarks for other plants or departments or divisions, or even external benchmarks from industry competitors. Standard cost systems benefits. Standard cost systems are widely used by manufacturing companies in the US and, of course, around the world. Now, these systems, what do? They help managers. How do they help managers? One, they prepare master budget. They set target performance levels for flexible budget. They establish performance standards. They determine sale prices for products. They determine sales prices for services. They reduce accounting costs. Now, while developing and maintaining standard cost systems require upfront investment, the benefits outweigh the costs. The standards must be updated regularly, at least once per year, to remain relevant. However, when integrated with an enterprise resource planning or ERP system, businesses can, one, they can track inventory costs efficiently. Two, they can analyze cost and efficiency variances. And three, they can make real-time, data-driven decisions, okay? So by improving cost control and decision-making, standard costing becomes an essential tool for effective financial management. Okay, now once cost standards are established, managers use them to assign costs to production. At least once per year, they compare actual production costs to standard costs to identify variances. In this exhibit that you see here, it outlines the formulas for calculating cost variances and efficiency variances. So you have the cost variance equal actual cost times actual quantity minus standard cost times actual quantity, okay? Then you have efficiency variance equal standard cost times actual quantity minus standard cost times standard quantity allowed. And with the flexible budget variance, it's equal to cost variance plus efficiency variance, okay? So the flexible budget variance, the cost variance plus the efficiency variance. So by analyzing these variances, managers, they can pinpoint cost overruns. They can pinpoint efficiencies and areas for improvement, right? Ensuring that a better financial control and decision-making is in the works for the company. A cost variance measures how well the business keeps unit costs of material and labor inputs within standards. So as the name suggests, the cost variance is the difference in costs or actual cost per unit less the standard cost per unit of an input multiplied by the actual quantity used of the input. For example, if the actual costs are higher than the standard, the variance is unfavorable. So as efficiency variance measures how well the business uses its material or human resources, it's very important for companies to have this in place to make sure that their company is operating with efficiency. Okay, so the efficiency variance measures the difference in quantities or actual quantity of input used less the standard quantity of input allowed for the actual number of units produced, multiplied by the standard cost per unit of the unit. For example, if the actual quantity exceeds the standard quantity, the variance is unfavorable. Here in Exhibit 9, it illustrates the relationship between variances It breaks down total flexible budget variances for materials and labor. It breaks it down into the cost and efficiency variances. So looking at this exhibit here, 9, the key takeaway from it is that 1, cost and efficiency variances together make up the flexible budget variance. And 2, static budgets are not used in calculating cost and efficiency variances. They are only used to determine the sales volume variance, which results from selling a different quantity than originally budgeted. So the variance breakdown, you have the flex budget variance equal cost variance plus efficiency variance minus sales volume variance equal difference between flexible budget and static budget. So by separating these variances, managers, they can better analyze performance. They can better analyze not only performance, but they can adjust pricing, and they can also optimize resource usage. Okay, so we're going to summarize objective 2. So we said earlier that a standard cost system, it helps businesses manage costs by setting expected prices, costs, and usage levels under normal conditions. And some of the benefits of a standard cost system is 1, budgeting and planning. This area, it helps in preparing the master budget and setting performance targets. Then you have the performance evaluation. It allows managers to compare actual results with standards to identify variances. And then you have the pricing decision. So with the pricing decisions, it aids in setting competitive sales prices for the products and services. Then you have cost control. It's another benefit. Well, cost control helps reduce unnecessary spending by identifying efficiencies. And then another benefit is the accounting efficiency, which simplifies cost tracking, especially when integrated with an ERP system. So how are these standards set? 1, direct materials. So based on purchase price, supplier agreements, and expected usage per unit. Okay, so direct materials are based on those, the purchase price, the supplier agreements, and expected usage per unit. Then you have the direct labor, determined by wage rates, benefits, and efficiency studies. Example, you have your time and motion analysis. And then you have manufacturing overhead. Well, it is allocated using labor hours or activity-based costing. So, standards must be realistic, regularly updated, and based on best practices to remain effective. So this is objective 2. And this is the end. To click the like and subscribe button. And if you have any questions or comments, please leave them below and I will reply to you.